how are we positioned in our portfolios? We actually are overweight energy. We have had that trade on for a better part of the year, and energy's been really, really strong. Um, and then we were overweight technology, which some people might consider to be defensive.
Hi, it's Goernert, investment advisor of Canaccord Genuity Wealth Management and Goernert Wealth Management. Now, welcome to the channel where we help you make sense of the financial world. Now, today, we're going to be joined by Kevin Vandermeer of Canaccord. Kevin, how are you?
I'm doing great. How are you?
Good, good. I see you're back in the office now.
Yeah, yeah, back. We've been back since about Labor Day.
Oh, that's
So
awesome.
back in the office, and it's a good change from
It is.
having been working from home. Obviously, everybody knows it has its own challenges as well. So it's good to be back.
Okay, well, hey, wanted to have you on because I just want to talk about a number of things that are happening in the market. Usually seasonality, September, October, those are kind of the weakest months from a seasonal perspective. We had some comments from Tony Dwyer last week, just commenting on, where he sees the market and the Fed going ahead with their tapering program. They've widely telegraphed it to be $15 billion a month. Want to talk a little bit about Martin Roberge's thoughts on maybe this is the end of the thoughts that we maybe only had transitory inflation, that there's something more serious here to stay. Well, how are you seeing the market and where you're positioning right now?
I don't. Yeah, good questions. So first of all, definitely there's a pattern that the market follows kind of each year, and that's called seasonality. And typically it starts, obviously in January, and it kind of goes up until kind of the summer months, and then goes sideways between sort of June, May, June till August, and then usually corrects back down, into it's kind of November, the end of December, end of October, and then rallies from kind of what's often called the Santa Claus rally, which means that the markets typically will go up and finish strong. So that's like a typical year, if there's anything called a typical year, and so yeah, we're of the view that the market should continue to be strong into year end, and our view would be that you'd want to be kind of risk on here. So you don't want to be playing more defensive names. You want to be in more seasonal, cyclical sectors. And so how are we positioned in our portfolios? We actually are overweight energy. We have had that trade on for a better part of the year, and energy's been really, really strong. Um, and then we were overweight technology, which some people might consider to be defensive, but it tends to be kind of a more growthy area. And so those are the two sectors that we were kind of overweight. And the third sector would be financials. Um, and financials are benefiting from here in Canada specifically. OSFI, the regulator for the Canadian banks, has allowed them to start to buy back stock as well as increase dividends. And we've seen that both Manulife and Sun Life, since that announcement was made last week, have both increased their dividends or announced dividends. So that's good for long-term kind of shareholders, or shareholders looking for income.
Yeah, cause and that's a trend that Scott Chan was on the show talking about. I guess to all of us about 6 months ago, that when the restrictions do come off, to expect increase in dividends and buybacks, and at that point he was even talking about potentially some acquisitions, although the market is improved enough. There's not as many accretive acquisitions as there was at one point. On the energy side, is it more weighted to oil and gas, or is it weighted to natural gas? Sorry, oil or natural gas, or both, the whole complex?
Yeah, natural gas is run pretty hard, in part by some of the structural challenges in Europe. But Russia has recently said that they will increase their quota, so you've seen natural gas come back a bit. But really where we're positioned is more in the producers. So, we in our portfolios we would own the big high quality names. So Suncor, C&Q, and Cenovus would be the big producers that we own. We obviously own Enbridge and Trap, and Pembina here in Canada. Now they would be kind of safer plays because they're not really leveraged to the price of oil the way that obviously Suncor and C&Q and Cenovus are. We also own in the U.S. We own Exxon and Exxon and Chevron, which would also be kind of pure play energy producers that would benefit from rising oil prices. So we're not necessarily you know our view is we don't have a strong view on the price of oil. If oil just stays here, um, you know, energy producers will do well, and they've really been out of favor for a long time
Hmm.
for lots of reasons. One being, that oil has been declining and actually went negative during COVID for structural reasons. But
Yep.
um, there's been a lot of underinvestment in energy infrastructure and in production. The demand for oil continues to go up, and it gets harder and harder to get oil out of the ground for many reasons. Some of them regulatory, some of them, kind of environmental, and even to get that oil to market or to sea, as we know here in Canada. Obviously, the pipelines and the restrictions and resistance to pipelines both in Canada and the U.S. So all of those sort of barriers and underinvestment, is sort of manifesting itself in a higher oil price that we think will likely stay here for longer.
Okay. No. Looking at what are the catalysts you're looking for in the markets in general? TSX, and globally aside from North America.
Yeah, I mean, we're sort of at all-time highs here.
Yeah, that's kind of my roundabout what I was trying to get to. Is like,
Yeah,
so.
yeah. We're off today, which broke kind of I think a 5 day or 8 day winning streak. But yeah, I mean, I think we're just coming to the tail end of earnings season here. The earnings were pretty strong. I think for the most part surprised people, and there's a sense that if the supply, we're talking about now kind of Christmas and what people are going to spend, and we won't get those numbers. Those numbers won't be reported until Q1 of next year. But certainly the consumer looks like they're ready to spend. The challenge is really around the supply chain and whether or not when we go to stores, whether or not the products that we want are actually on the shelf, and if they're not, will we substitute or not spend or spend on something else. So I think right now the consumer is pretty strong in the US, same in Canada. They're ready to spend. We've all kind of been been restricted in our movements, whether it's travel or just getting out of our homes. So I think people are ready to spend and to move around, and that probably bodes well for businesses. The other interesting thing is that even though we've there's a lot of talk about inflation, profit margins and have held up really well. And so what we've seen is that businesses have been able to pass those costs on to us as consumers. We're quite ready to spend our money to pay more for things. So I think yeah, I think it looks strong and likely to continue. So with earnings, if we all continue to spend, that'll bode well for earnings, and earnings will kind of ultimately drive markets. So I think into year end we would see the market higher, and then even into next year.
And that's a
Um,
good, that's a good point because when you talk about pent up demand, from my economic background, I can't think of a period where we've come out of a recession where consumers have been in such good shape, like with
yeah,
cash in the bank and literally looking to spend it by next Tuesday if possible. And so.
Yeah, I mean, the housing market in the U.S. has been really strong. People can't, almost can't even buy a house because they just, the supply just isn't there, and that's really a hangover from the, the credit crisis where you had all those challenges in the housing market and people stopped building houses for a while. So
Hmm.
that's finally caught up, and now there's not enough houses for people to buy, and as a result, the price of homes is, at all-time highs, which means that Americans have equity in their homes,
Yeah,
and typically Americans um, spend money. Uh,
yeah,
they're consumers, much more so than Canadians actually. So, yeah, so the consumer's in good shape. They haven't been able to spend, and it's they don't seem to be too bothered by higher prices at this point, and it's really now, can we get can the supply chain issues that are impacting all of us, whether it's semiconductor chips in cars or video games or other goods that we buy, can that be resolved, and we can buy products and spend money again.
yeah. Hey, well, why don't we wrap it up there? Great to see you again. Great insights, Kevin Vandermeer. See you, Kevin.
Thank you. Bye for
Bye.
now.
Thanks for watching. If you want to see more content like that, please consider subscribing or join me on my website, ggoernert.com. That's ggoernert.com. Look forward to seeing you there.